You're recording. All right, we are back with Hugh Hendry. Hugh, thanks so much for joining the show today. I'm really excited to chat with you.
Well, nice to be on. I'm sitting in the therapist's chair, and I'm ready to be diagnosed.
Oh my God. Well, I don't know if we'll diagnose, but we'll certainly try to pull some things out of you, right? So I think where I wanted to start, there's so much to dig into, but as I was mentioning to you before, one of the things that's been really fascinating about your kind of whirlwind reemergence onto the scene of the macro brain set, or I don't know, whatever you want to call the place where we all discuss these things in public, is that I find that, a lot of folks who are in this industry are their job, the way that they get paid is they're managing someone else's money. So they try to have their theses fully formed before they get public, right? And by the time they get to you, they're talking their book, whatever their book is, whether it's their investment or it's their just their kind of their particular perspective. Whereas what I've noticed is you kind of really trying to absorb a huge amount of information, spit it back out, and make sense of something. And I think it's coming off to a lot of folks as incredibly authentic, because so many of us are also trying to absorb a lot of information and make sense of a world that feels like it's changing really quickly. But I think that for our listeners or our viewers, let's give the kind of the brief version of your history and how you got here from a hedge fund manager into sort of this very vocal figure that had a kind of public shift in your perspective to a very different volatility at the end of the world trade, as you put it, to kind of back to where you are now.
Okay, well, let's see if I can do this short so we can get to the kind of juicy things. But I guess I came from, like, in the American context, a kind of housing project, really, really tough. And my family didn't belong because we were perceived to be kind of on the make in terms of wanting to get out, wanting to get very, very far away from that place. And I think I want to say I suffered some form of non-physical trauma during that period, which kind of really kind of shaped and formed the kind of anthropologistic person I became, that I have always been somewhat detached. I've never really retained, I've had many deep, wonderful friends, but they've been episodes and chapters of a life, and we've continued to evolve. I found that there was it would seem like there was an incredible fortuitous set of circumstances which kind of was able to pluck me from that very difficult and challenging background. Albeit one could say that the harder you work, the kind of more fortuitous you become. But but definitely it felt like the I don't really believe in God. God is dead, to quote Albert Camus. But it felt like definitely there was someone pulling strings. And so I I found myself with a prestigious, very proper company working in Edinburgh, very sort of academic and rigorous. Then I found myself in London with one of the original European long-short hedge funds. And at all times I was a troublemaker. I hear these damn voices in my head. It's like feeling the vibration on the rail track, and there's a huge locomotive coming. And in the early part of my career, I didn't really have the legitimacy for people to stand aside. And so the train would approach closer and closer, and I'd become more and more agitated. And kind of that's where the troublemaker part came, because I'd be shouting, I'd be trying to, protect people. I had a very fortuitous meeting with an astonishing mind in London, a chap called Chris Benodi. And then he taught me to misbehave. And it's that kind of misbehavior which forms curiosity, which allows you to kind of try and decode whatever is out there on the markets. And then from there, it's almost like the pattern recognition became almost like the way a musician would look at a sheet of music, like a musical score. And so again, I worked on that. But anyway, I got my own hedge fund, and here I am, the boy from the housing project, now has a glorious lifestyle in a billionaire island called St. Barth in the French Caribbean.
And so you packed up that hedge fund a few years ago and started to focus on this really unique place. I actually want to come back to St. Bart's and talk about it a little bit because I think it's the way that you look at it is fascinating. But what was the genesis of, well, I guess, one, removing yourself from this world for a minute that you had occupied for a while at that point, and then two, how did you find your way back?
Mm. Well, I don't, I've always, I'm passionate. I mean, I'm passionate about anything, trees or whatever, but I vibrate. I drive my wife crazy, but I vibrate. I kind of need pills to calm me down. If I just get agitated, I vibrate. Um, but the business after 2000, at the end of 2012, I wrote a famous letter to my clients. And I was kind of borrowing a kind of iconic reference from what was my favorite show, Entourage. So, Entourage, kind of like the supposedly the kind of life of Marky B or whatever. Um, but in Hollywood, but there was a great line from a kind of a director who had enjoyed great success, but many years ago, and the lack of recent success, of course, always eats away at your legitimacy. And so there's a great line. He was famous for kind of saying to anyone that would listen, "What if I was to tell you this movie will cost us $40 million to make? We'll win 3 Oscars and we're going to gross 600 million. Is that something you would be interested in?" Of course. And so my conjecture was, what if I was to tell you I was turning bullish on equities? Is that something that you would be interested in? And I knew what the response would be. The response was a very emphatic no. And some newspapers and magazines of the time carried articles about the last bear turning bullish. And the thing about that is today, today, people still argue and dispute whether I was right. I'm turning bullish at the end of 2012 on the S&P, and people still dispute whether I was right. And so that conflict, and that having found myself boxed in terms of this perma bear, and then even rejecting it and not being allowed to reject it, slowly but surely made my life joyless. And I found myself losing clients, and then the clients finally kind of just, I had not enough money to sustain the business, which was the end of 17. We had this enormous hurricane, the force of the Hurricane Irma in the Caribbean. It passed directly. I mean, this what I'm talking to you under like a 25 kilometer. It's a speck of dust in the ocean, and yet this hurricane, which was the size of the France is a big country, 65, 70 million people. The eye of the damn thing passed right over this island, profoundly devastating. And in the same week, I lost a large client, and the business came to an end. And so I spent, really, if you will, I entered confinement. When everyone was forced into confinement in March of this year with this blasted virus, I re-emerged from my self-imposed confinement.
So this is actually super interesting and actually a little bit different of where I thought I was going to go right away. But, I've heard you talk before in similar ways about even having kind of the financial press take something that you had said about Bitcoin, right, and then turn it into a narrative position, right, that you were anchored to, that you were tethered to. How much do you think we maybe don't appreciate the way that the rise of social media and kind of the rapid transmission mechanism has forced people who are in finance into these slots, right? Like you're forced to be in one tribe or another, represented by easy kind of Twitter soundbite-esque positions that don't allow people to have kind of the full a full reflection and changing opinions, because that would kind of lose them audience that they had gained.
Yeah, well, with respect to financial managers, people managing other people's money, and those other people being, if you will, institutional clients, there is so much kind of risk checking. So everyone needs a defined nature of who you are, what you represent, and people. I want to say they really enjoyed interviewing me, except at the end because they had no notes. They were, I'm a talker, you know. And the great problem was the kids who have to write these things up to and get them approved by the investment policy board. They were like, I don't know. So, and I used to joke that I used to dare people, you know, give your money to the guy who hears voices in his head, the paranoid schizophrenic. Not a viable marketing campaign, I would add. But no, the need, the simplicity of a definition is something which it can and probably does haunt all professions. And I very much kind of rejected it. I stood steadfast against it. But you get chiseled down. You make it, you know, what if you're not prepared to define who you are, then you are actually passing risk on to the person who has to make a decision and a judgment. So it's kind of past the hot potato. I was like, hey, listen, you know, my argument was always, if you wanted to reduce car deaths, put a huge dagger from the steering wheel. You'd be driving and you'd be looking at this enormous, you know, and if you made a mistake, you would be impaled. Okay. I promise you that would overnight, you would reduce probably by 80-90% fatalities from road accidents because people would drive down carefully. And so people kind of, I was the reverse of that. I was like, hey, you take I was putting that, I wasn't the reverse. That's what I was in that equation. I was putting the dagger very firmly in the steering wheel and saying, I dare you, invest, you know. Like, I dare you to do the homework. I dare you to take risk, you know. I like daring people, but people don't like being dared, especially when it's other people's money.
Yeah. Okay. So let's take it up to this year, you know, so there's a personal cadence for you coming back in, but there's also, you know, it sounded like, you were starting to try to figure things out that were just not making sense to you, or at least the kind of conventional wisdom that was flying around was insufficient. I mean, is that the case? You know, I mean, you've started to produce a lot of content, both this sort of conversational content, but also written content. But, you know, as you started to hear voices again, right, in the context of this market, what were they talking about? What was the impetus specifically that you wanted to kind of have a stake in the conversation again?
Well, I had an awakening. I think last Christmas, we always get a huge influx of very, very successful people onto the island of St. Barth. And I was beginning to think, like, I was hearing myself in introductions and what my story was. And there's just more and more young folk in finance. And, you know, most of them hadn't heard of me. And I was just thinking I was becoming irrelevant, and my great ego would not allow that. And so the hardest thing was to challenge the inertia which had grown up around me in the last 2 years, and how I could kind of come back. I had absolutely no desire to manage other people's money. And so I kind of hit upon the idea of doing a book of my kind of cranky, eclectic letters over the course of the last 15, 20 years. But then I thought to myself that the better thing to do would be like this kind of podcast series with a very good transcript, which kind of would end up being the book in slow motion. And so I began analyzing my thought process back in 2002, 18 years ago. And the thing is, like, who cares? Like, who can, like, can you remember what the top song was in the charts? Like, no one knows, no one cares. But the idea really was that I'm dealing with uncertainty. And I'm dealing with uncertainty kind of in an eccentric, cavalier, interesting manner. And you, either reading the transcript or watching or listening to the podcast, you kind of know what happens next, you know. And I'm saying, and so I pressed the red button. You're like, don't press the red button. Anyways, I embarked on that exercise, and I began to recognize that all of the voices, which is to say all of the kind of chart setups, and the chart setups versus the narrative that people were sharing, like, I suddenly had 2020 vision. That 2020 just seemed to be the same setup as 2002, and that back then I had conceived of a narrative which would have a dramatic third and final chapter where the true explosive move in kind of precious metals would take place. And so I suddenly thought, wow, this was just meant, again, I said to you earlier on in my career, it felt like there's a fortuitous set of circumstances which was kind of leading and promoting me and taking care of me. Now I have to say, it took 8 years of me being very, very miserable before that benevolent hand intervened in my career, my lifestyle. But the benevolent hand, I want to say, reappeared in sort of March, April of this year. And you hear me talk about, again, I like to have fun with words, and people are very cruel, and they're always thinking I'm a moron, and I'm always very quick to correct them that I'm an oxymoron. For instance, I'm a contrarian trend follower, and I say that because it's very apropos the current situation. So I made money being a contrarian trend follower. What does that mean? First of all, I never feared the consequences of being wrong. Okay. Secondly, I was looking for legitimacy. So anyone can have a narrative, but you're looking for a narrative which has the legitimacy of a supporting trend. And I find that it's actually the majority who act in a contrarian manner. So to put that in today's context, yes, people kind of getting and enjoying the gold and the silver move, and of course Bitcoin and whatever else. But for all of them, there's many people who would say that we saw this move in 2009, 2010, and then it disappeared. And then there's all the people who would discuss why it's happening and would be very, very critical of the monetary authorities, and who'll tell you that bonds are terrible and that the equity market's over expensive. But all they're doing is, the trend in all of these assets is very, very positive, and they're imposing an intellectual narrative and an imagined reality, which is very much at odds with the reality of the trend. So I guess the best way of summation is my imagined realities were always in keeping with the reality of the trend. And that kept me out of trouble. But remarkably, it kept me contentious. And so I'm finding myself contentious again, and reaching out with Twitter. Hey, who knew? It seems to be a shitty business, but as a platform, and you can just go, pow, and like just take someone out. It's just amazing fun. And so if someone writes BS and they append my Twitter handle to it, more likely than not, I am going to visit you and I'm going to correct the errors in your commentary. So,
how much of the trend problems that you see are just about the wrong time scale, right? Trying to zoom in too far and construct a narrative from that without kind of moving out with sufficient distance.
Yeah, that's certainly one of the skill sets. More is better. Yeah, the number of times when people send you a chart and it's 3 months or 3 months, or God forbid 3 weeks, that's like seeing a portrait of some fantastic battle scene, and you can't kind of work out where you are. You've just been shown 3 weeks. I love lots of data, and there are particular setups. And the thing that got me excited was I love the ebb and flow of nature as it comes through the kind of REM processing of millions of intelligent and otherwise people. And so I like this notion of a bull market. And then, of course, a bull market is just the expectation of something which is yet to happen. And in some instances, it doesn't happen. And therefore, you have these profound bear market crashes. And so then the brutality of prices falling 80 or 90%. And when that happens, typically there is no future. But then you see, I love seeing redemption. I love seeing a kind of 10 years of the share price no longer making lows, or it doesn't have to be a share, it can be gold, it can be a currency. And then it creating a very, very narrow base, if you will. And then out of the blue, it makes a 10-year high, which is to say it's still 85%, it's still 75% below its all-time high, but it's actually just quadrupled in price in the last 6 months. And that's when my voices get very, very agitated. You can find, it's not guaranteed, of course, but I'm always fascinated by the process of redemption, and that actually the future that people thought was going to happen 10 years ago might actually be happening now, and no one cares about it. Those were always my favorite setups. So my fascination for gold back in 2002 was that it had that profound bear market. And if you put it, and I like relative price charts, relative bear market. So a devastating bear market versus the S&P of the magnitude of 90%. And then no new lows. And in absolute terms, it does nothing. But of course, just the sheer devastation of the bear market that began in late 1999 meant the relative price of gold started to kind of register something. And by the end of 2002, you could start, there was a lot of contention in my head from these shapes and patterns, and then my engagement with a smart group of young kids who would then question me. So that's how my kind of mind begins to start a process of discovery. And then I've always had like really smart young kids, much smarter than me, who go out and challenge my thesis. And that's the synthesis of that work is is what we've achieved over the years.
What is the redemption story that's interesting now, or what are the redemption stories that are interesting now? The futures that people imagine that didn't come to pass, or perhaps the future that people are imagining now that doesn't seem likely to come to pass?
Well, the remarkable aspect of today is it's kind of what's to stop it? What's to stop? Like as I say, I kind of wrote at the end of 2012, which is 7 long years ago. Why can't we have a repeat of the last 7 years? I think the answer. I don't think there's anything economic, financial, in terms of the tenets of the laws of economics and finance. I don't think there's anything that would interfere or that would stop the next 7 years being very similar to the last 7 years. I think the most likely source, and of course it's conjecture, is really whether society will permit it. And there are red flags in that the UK and Britain, of course. So I'm referring to the Brexit, the UK's judgment to leave the continent, is a kind of red flag. That's kind of people getting angry, because the most logical thing would be to kind of stick with the status quo. That the kind of transaction cost of breaking that thing just kind of doesn't. It's not obvious that the upside is many times greater than the kind of transition cost. We will see. Future will judge that. But people decided to kind of, I don't care. You know what? You tell me about cost and you speak to me rationally. I'm angry. I don't care. This is going to happen. And it came to pass. There's clearly anger. There's a degree of anger which has fueled Trump into his ascendancy. And I'm kind of, Trump is many things, and it's for others to kind of to impose morality. But Trump represents a curious. I seem to be a great lover of all things America, and maybe I overdo it, but a liberal democracy pursuing curiosity and being playful is going to make mistakes. But the fact that it's reaching out to Trump is a reflection that the totality of American society recognizes that today doesn't feel correct, that today needs, you said redemption, that today needs leadership, and it needs perhaps a different path and very much a different narrative. Now, it may be that liberal democracy in America got it wrong with Trump, and it may get it wrong with Trump 2, Trump 3. But the fact that it's trying, I think, is ultimately going to prove its salvation. It will ultimately find redemption via that curiosity. And I don't really see that curiosity elsewhere.
So yeah, you had tweeted at one point, I think in reply to someone else, for as long as we avoid the inevitable popular revolt, the status quo will deliver exponentially. And I think that's kind of what you're referring to. But the interesting thing is that we have this strange moment now where I think that you have narratives for both what went wrong and what we should do to fix it. That's really what the US political debate is about, right? In I think the 2016 Bernie versus Trump fight that so many people wanted, even though that's not ultimately what they got, it was two different stories about what went wrong, and two different ideas about how to change it and what might go right. And now I think it's a little bit different this time around, but there's certainly a kind of left-leaning and a right-leaning narrative battle on, what feels wrong, the way that you put it, which I think is really right. Interestingly, however, both sides seem to be getting comfortable with somewhat similar economic policies, at least as it relates to individual citizens, right? Which is the debate, for example, right now between the Republicans and the Democrats is not, should there be stimulus or not, which it might have been 10, 20 years ago. It's, does the package look closer to 1 trillion or 3 trillion for this go around, right? Which is a remarkable shift. And so I guess that, bringing the financial side back into this has actually that the ground upon which we stand in some ways shifted irrevocably. We just don't see it yet.
Well, it shifted, and I think it has shifted irrevocably in the world. And this is contentious to say, but in the world of central bank policy making, which kind of ultimately, can shape. I mean, they actually by making them independent, they gave them the superpower that they could kind of do whatever they want. And of course, I guess with the caveat that if they truly screw it up, they'll get reined in and they'll be punished by losing their independence. I want to say that, again, in terms of what is the check on the exponential nature of, I was going to call it prosperity, or on the asset price speculation kind of ascendancy. What is the break? Because the break used to be ideology. It used to be the ideology of the people who ran banks. And that ideology kind of, it was still there and evident. It is still there. But, the Federal Reserve raising interest rates brought down the housing market and created an almighty. The Federal Reserve beginning to raise rates, I think, from when did they start raising rates? Like preempt, a little, just tiny. Didn't they do something in 2014 or 17? Anyway, in my mind, who cares? The desire to be seen to be doing things right. They can't really come out just now and endorse that the natural rate of interest is either zero or negative. I mean, some of the local Fed presidents are kind of writing to that end. They're kind of trapped just now by the notion that they can't go like really negative with interest rates. And there's a huge consensus that negative interest rates do not work. But we've only tried negative interest rates, and they've been defined by basis points and not percentage points. So I'm very curious about, I could see us moving from basis points to percentage points. But I kind of want to say that at the end of the 1920s, it was a hard money ideology, the kind of Andrew Mellon and purging the system of its rottenness, of its complacency. Sounds noble. It is noble, and there are kind of strict kind of economic doctrines that could push you that way, but you are sacrificing ordinary people. And when you had Bernanke, many decades later, when he was chairman of the Federal Reserve in the noughties, and when he stood up, I think was it the 90th birthday of Milton Friedman, and he apologized on behalf of the Fed for that decision, which created at least 10 years of depression and all the dramatic kind of awful emotional things that did on families. That, I want to say, has gone. And that's not really being embraced. That the people, the most vociferous critics of central banks today are ideologues, and they want to raise interest rates. They tell you that the Fed has manipulated everything. That is an imagined reality. Now, I can't tell you if it's a true imagined reality. My suspicion is that is not a true reality. The price reflects this extraordinary world. Like, where should 10-year rates trade? Where is American GDP going to? Where are they going to print for the year? It's going to be what, somewhere between -7 and -12, or at least -12. It's going to be an unprecedentedly grim number. And people tell you that the Fed's manipulated market rates. I'm like, should they trade at 3%, 4%, 5%? What's wrong with 50 basis points? So you have zealots, and they want to impose something which is not market-based. And if they impose, thankfully, the central bank's not listening, because if they imposed it, it would just destroy families and life's. I don't care. I mean, I don't care about ideology. Let's not destroy families.
So this is really interesting. And this is another thing that I wanted to ask you about, because there was a period after that, after 2008, right? Which is, you had spent time watching this almost, it feels like you were watching it unfold in slow motion in some ways, where you had that anger, you had that frustration. In fact, speaking of being pigeonholed for it, right? For a time you were, that's why it was so surprising to people when you kind of shifted your perspective in 2012. How did you start to, what shifted your perspective, I guess? And in particular, one of the big questions right now is exactly to your point, the question about income inequality and kind of the growth in asset prices versus wages and people's ability to participate. I mean, how does that fit into, I know it's something that you care deeply about. How does that fit into your understanding of the role of central banks?
Yeah. So thanks for bringing that up, because I had to deliver a mea culpa. I had to say, forgive me, that ever since, so I made a nice profit. I made 50% in the month of October 2008. And so for the year, I think the figure was about 32% positive. And I expected that we would get this. I was Andrew Mellon. Hey, let's purge the rottenness, all these complacent people who got away. And so I think 3 years later, my mea culpa was, I'm there to manage your money, not to be your moral compass. And so directly to your question, what changed? What changed was still the discipline. Remember, I always sought legitimacy from the market itself. And I found that I was breaking my golden rule. I was going against the prevailing trend, which was absurd. Now, you're allowed to do that for brief little periods. It's very, like, we have red lights flashing whenever I do that. And it's like, you've got a half-life of hours, but this is unsustainable. This is unsustainable. I give myself no more than 3 years. 3 years is Jesus, it's a lifetime in terms of the world of managing a leveraged macro portfolio. And so for 3 years, I had very much extinguished all of the goodwill that I'd achieved in 2008. And don't get me wrong, I didn't lose money, just didn't make money when it was so damn easy to make money. And I was really, really annoyed at myself. And so the kind of 3 year time window, and the fact that, hey, someone takes you out, I had someone that takes me out. And therefore I had to search for another way. You've seen that. You've seen that since 2015. A lot of macro people telling you that the Chinese currency was going to collapse versus the dollar. It may eventually, but I could see back then and today I don't see any reason that would support that. There are people who've been arguing that case for 5 years. They're still launching products today. Those products are very, very leveraged. They're very simple option products. And they say to people, just give me 1% of your wealth. You're guaranteed to destroy 1% of your wealth. So narratives need to be disciplined by the passage of time. And that message, that kind of, what I want to say, grumpy kind of moralistic kind of curmudgeon was timed out at the end of 2012.
So that's part one of the question, I guess. But then part two has to do with the income inequality. Do you think that the folks who think that income inequality has been exacerbated by asset price growth, are they off? Are that missing the mark?
I, I, I think there is greater fear about upsetting savers and like these like really low rates that you get, and of course people retiring and searching for an annuity and finding that the income that the annuity provides is not enough for life. I think there's kind of more policymaker angst about that subject rather than the disparity in incomes, and that bothers me. The A lot of the disparity, I think, is emerging from there seems to be a flaw in the capitalist system today, which is that too many important actors, and this is kind of part of the Trump kind of trade policy, but let's call it principally Germany representing Europe, and China, um, have been using the US as the consumer of last resort, which is to say that those countries are just saving too much. And the consequences of that, that first came to our consciousness because they had so much savings that they were so determined to put it into America that we had the kind of cheats and liar loans to ordinary households were being enticed to take on loans, with teaser rates, which would trap them, and then they would turn viciously, and then you would go through all the trauma of losing houses, etc. Was coming from this mercantilist trade policy that we see in Europe and China. That has to change. That has to change. They have to pay people more money in China. They've got to have a stronger currency in China. They've got to kind of let some of these state-owned enterprises disappear because like ordinary folk are being suppressed. That the heel was crushing them to keep afloat these monolithic, stupid companies. The US is making mistakes as well. I mean, I in my head, I'm kind of playing around. I've got a trade in my head. But I don't think we've seen the last about this story about negative interest rates. And I think if I wish to be provocative and look to the future, I think we will see negative interest rates globally. And I think they will have handles of 1, 2, 3 percentage points negative. And that will be punishment to that generation of savers. I think we were talking in the intro about how I can bookend a 50-year period from the 1970s to today, where we pivoted from chaos to order, and the imposition of order into our economy was an immense boon to the creditor part of the economy, and we're at the end of that thing. It's going to change, and we've got to work out how it becomes how the system works for the debtor. The debtors are the people with ideas. The Steve Jobs things about the square pegs and round holes. We're kind of scared of them. They kind of smell. They look a bit kind of fruity, but they're the people that could change the world, and they need your help. They need your money. And the problem with the exchange of ideas for money or money for ideas was that the creditors were being overpaid, over rewarded for that decision. That is slowly changing. I think it will accelerate, and I think again the notion of redemption may lie in that route. But that's me sitting here kind of just with conjecture for the moment.
All of us are sitting here with conjecture. It's just we all kind of play a different role in how much we're willing to stand by that conjecture. But this is part of why I wanted to have you on the show, is that I know that a lot of the folks who will be listening to this have a different take on where this income inequality came from. But what interests me is when people have a similar diagnosis of problems or a similar recognition of problems and different diagnosis of both cause and potential solution. Because all of a sudden, if you're debating that, you're in such better territory than just screaming at each other about what's kind of wrong. And I think we miss that. So I just want to expand on this just for a moment. It sounds like, and this kind of got, I think, also to the heart of your conversation with Luke Grauman on Real Vision, how much the real culprit here is the structural imbalance between the U.S. and the rest of the world, and the kind of the how much got pinned on basically the backs of the American worker, the average American family, in structuring the system that it became. And when you talk about savings, you're not just talking about kind of the average family who wants to save some money for, you know, a vacation or a, you know, rainy day fund. You're talking about kind of globally the savings imbalance between the U.S. and everyone else. Is that correct?
Yeah. Yeah, that's correct. Heavens, there's so much there. So you're correct. Let me see if I can take these back in order. When people do disagree, like what I was saying is, would have many people shouting at their iPhone or what have you. Those people offer an alternative solution, which is that interest rates are too low, they should go up. You're going to get a huge amount of savings from that, because people are going to lose their jobs and they're going to be forced to save because they've got no money coming in. So if you're trying to solve income disparity, raising interest rates is a catastrophic idea, in my low opinion. I go on in my tweets about the benevolence of a global hegemon called the United States. And I dare the naysayers to rerun the last 100 years without the role of the US. Obviously, we've had global wars, etc. But I think it's never happened in history that you had a nation, a sovereign nation, that was willing to take on the hardship of the displacement of people of communities losing their job. You know, there was a huge displacement. There's a huge displacement that happens when you bring the other half of the world on stream online. They kind of conceivably are as deserving of a proper lifestyle as all of us, but there are consequences as we bring them online, that they enjoy comparative advantages to do things kind of not necessarily smarter, but more productively than you could do perhaps in the US. And the US, I think, stands alone in having the foresight to recognize that it would be kind of better to take that pain today in the expectation of sharing that prosperity and having very rich neighbors. And in the future, that you're very much, the pie is much, much bigger than the alternative path of denying that. Now, where we run into trouble is that happened, you know, the 70s, and, you know, Martin Scorsese movies, the Deer Hunter and stuff, just was showing you the raw edge of the displacement of steel workers and what have you. And this is kind of payback period, you know, because the US has the Chinese had the ambition to be the size, if not the greater size of the American economy. But I still feel that they're kind of backsliding on the promise. It's like, guys, we took the hit. You know, families lost jobs, they lost homes, they lost education, they had to move. We took the hit, and we took it to make you richer. And so now you should be investing because you're rich, and you should be doing stuff. Like, your people should be a lot richer, and they should be buying our stuff. And the Chinese are behaving as if they've still got a country of peasants, and they need more and more, like the US, to impose more and more hardship on us ordinary folk. And it's like, guys, we're done with that. You know, wake up and change your model, right? You know, you have got an amazing infrastructure, right? Done, right? But you've got lots of shitty companies. Get rid of them, right? Let the currency rise and let the people get richer. So that's a debate that's going on there. The other debate, which is, let me criticize the US and other Western nations, is there seems to be that grotesque odor of ideology, which seems to deny us a world-class infrastructure. It seems that you can raise money you don't even have to tell people what the project is. You call it's a secret, but I'm a money maker and I need $1 billion. Done. But you stand up and you say, like, the US has the shadiest infrastructure in the world, and yet we're the kind of the best nation on earth. These things don't go together. Obviously don't give me $1 billion, give me we're talking trillions these days. Give me 3 trillion, give me 5 trillion, yeah. And yet people deny it. That's not it's not going to happen. Why? I don't understand. There seems to be a deep ideology that is so suspicious. We've got to like the 50s. I don't care. Like, rebuild the damn roads. Like, get fast. You've got Tesla there and his tunnel thing. Let's get these things moving. Let's get internet like really fast everywhere. Let's spend money. And yet people won't do that. That drives me crazy.
Well, I think what's so fascinating about this and that where you're coming on, and I think that a lot of this is hinted at maybe in the Dawn of Chaos, which you wrote, but I think is you could go even further with is that I wonder if actually by framing this big secular shift that we're living through strictly in the context of financial flows, rather than bringing in the geopolitical, rather than marrying those two sides, we're actually missing something for either of them. So I've had Peter Zayan, who wrote Disunited Nations, on the show before. It's a great book about the kind of 30-year American withdrawal from the system. But the interesting thing is that what you add to his perspective and analysis is this idea that there is some natural evolution of what is supposed to happen next based on what the US thought it was buying with its kind of bringing everyone into this world order. And if that isn't happening, that's a geopolitical issue as well, not just a financial issue that's going to have consequences. And we might be looking at mostly the trees rather than the forests, right? Individual trade war with Trump. The fact that China is now, 73% of Americans have an unfavorable view of China. It's the highest ever. It's popular on both sides. These might be larger structural issues about a need to rebalance. And I think, to your point, there is an at-home piece of this, which I think the virus has exposed, right? Even the conversation that we're having now, right? The $765 million loan debacle to Kodak. Really, I think that's the leading indicator of a lot of things that are going to happen as we try to reshore, quote unquote, or whatever term you want to use. But it feels like we're very much at the beginning of a new sort of Marshall Plan-y era for back home. And in some ways, I wonder how much the question is to what extent we view that strictly in terms of these kind of one-off programs like, another extension of stimulus support or debates about MMT and UBI versus a structural shift in how we think about the need to actually rebuild kind of America in a different context.
Yeah.
Thought more than a question, right? Of course. But.
Yeah, indeed. No, I mean, there's just so much. There's so much in that. But the one of the points from the Dawn of Chaos was challenge. I guess challenging is not the right word. Inflation is a monetary phenomenon. It's a fact, but it kind of it ignores that it is actually that there are other phenomena which kind of have to, there's a kind of chain reaction and another phenomenon has to take place first. And that other phenomenon is in this kind of soft, intangible world of the psychology of you and I. And, what I try to do is I try to go, the German economy suffered this catastrophic hyperinflation. These events are remarkably rare in grown-up, civilized, developed economies, and it happened. Germany was kind of like playing the role of China to the UK being the US. The UK had the Industrial Revolution probably over the course of 50, 60, 70 years. The Germans did it in 10 years as the baton is passed on. But with and so they were destroyed by this hyperinflation, but the hyperinflation really was a function of anger. The Allies, having won the First World War, insisted on basically gold was their foreign exchange reserves that you hold to protect the integrity of the nation, to make it trustworthy to foreign creditors. And the Allies demanded the transfer of all of that gold bounty. And one by one, it just made a divided nation very, very angry, and they turned in on themselves. They started like shooting politicians, and the shooting thing happened in Japan. They were, would you believe, they were killing the Bank of
Central
Japan.
bankers, yeah.
Central,
Yeah.
and you wonder why the Bank of Japan is very, very nervous in doing anything. They're like looking behind themselves all the time. So it's easy to say inflation is a monetary phenomenon, and at the end it gets printed and it moves. And you know, you could carry $1 trillion on your mobile phone, you know, digitally. You know, so you know the next transmission mechanism could really just the ground is parched and it could really go. The hard thing is getting it to the point where people are so angry, but again, the US so there are divisions. Everyone recognize the divisions just seems to have accelerated in terms of the two tribes just now in the US. Even the virus seems to expose two tribes, and um, and there's something remarkable going on with the little comment, which is that volatility, you know, this kind of the expectation of the daily ups and downs and the swings in fluctuations of risk asset prices has remained elevated vis-a-vis the record of the last 7 or 8 years. So it's kind of there is definitely a voice in my head saying, watch that, because that's really strange, especially given this dramatic recovery in asset prices. For volatility to remain as elevated as it is, the market's kind of yet to process. And what it's, of course, it's volatility is being anchored around the election month of November, and so people, you know, the big fear is really more that if Trump loses, that's the huge volatility event, because the question is how he deals with it, and how his tribe deals with it. And I think his tribe is perhaps more, what is the term, noisy, than liberal. You know, the kind of liberals are just, they'll write opinion pieces to the Washington Post, etc., but they'll kind of, you know, drink coffee and get on with it. Whereas it's the other guys that's the concern. So there's, you know, Germany was a divided nation after the First World War. The rest of the world kind of was very, very mean and took it down a peg, humbled it and kept humbling it. And then society turned it on itself. And so we just have to watch this tribal thing and the manifestation of that around the elections this year. I'm sure it'll be fine, but, you know, it's a risk factor.
So I've kept you for a while. I could keep you here for like 3 hours, but I want to respect your time. And so maybe let's do this by way of wrapping up. Instead of trying to sort of explain in full the thesis that you have in the Dawn of Chaos about what could help us out of this, right? And what we need. Let's preview it, right? Let's preview what the sort of, you have this contrarian a little bit perspective on what it would actually take to get the kind of engine up and running in a way that would make sense. That's certainly not a return to the gold standard or something like that. So maybe let's preview that with a promise that to the listeners that I'll try to have you back on soon, and we can dive kind of deeper into some of the financial stuff from where we were today.
Okay, so well, thank you very much, everyone, for your patience and lasting this long. These things are, you know, the challenge is to find brevity, and actually hit the points you wish to make. I think my parting shot would be that the system, if fully operated, the monetary system, if fully operated, could be the source of a lot of solutions, but of course also a lot of potential trap falls in terms of it. You know, we can find a solution, but we have to kind of make sure that that solution involves the many and not the few. Okay, I want to say that there's been an ideology and a conservatism in the way that central banks operate. It's almost, we impose that upon them. That it would make sense that we would impose that upon them. I want to say that the central banks have been doing this thing called quantitative easing. And they become a little bit brazen. You had Jeremy G. Powell on American TV, and they never say this, but he's saying, yeah, we're printing money, and we'll print a lot more money. I mean, that's not Fed speak typically, but there does seem to be that the heart's not truly in it, and this QE process, the expansion of inert bank reserves, it fooled a lot of people at the beginning, but it's not fooling that many people now. Japan started this in 2001, and they're on the 27th version. How many times can you bend a duck, and give it another name? It still quacks. You can call it what you want. This thing quacks. It doesn't work. And what I was hinting at, or the market is hinting at in the dawn of chaos, is, so tell me again, I make dollars plentiful. Like, I massively increase the spigot. I just pump dollars into my economy. And therefore, isn't the consequence of that would be that the price of a marginal dollar unit would fall? But the weird thing is that since you've been doing this, each marginal dollar that you produce is becoming more precious and more valuable. So you're just making this up. You're not doing it. Your heart's not in it. There's still an ideology that's holding you back. Yeah. And so they've jettisoned a lot of ideology, but I kind of reason that perhaps the central bank we're asking an impossible thing. We're asking it to be very, very irresponsible, like really, really irresponsible. And these guys were not made to be irresponsible. Put me in charge, or like I said, put Joe Rogan, someone like a caricature. I'm not being tough on Joe. The Joe would be fun, but it's a game of psychology, and you could really challenge it and create. If you can change behavior, you can change history. Yeah, if you can get in people's minds and make them think differently, you change history. And that's the next step.
Well, let's leave on that provocative note. I know people are going to be screaming at their earbuds for more, or to yell at me for not digging into Bitcoin with you, or at you for not explaining further. But that's what repeat invites are for. So Hugh, thanks so much for hanging out. It was really, really fun, and I think really important, big questions that we are discussing here today, and I think we all need to be asking.
Thank you very much, Nathaniel. I fear that some of my responses, I'm going to be rehearing them in my head later on, going, oh my God, I'm such an idiot. So apologies to everyone, but thank you very much.
Well, that's great.